My name's Perry. I live in the prairies of Canada. Um, I'm 61 and I just retired a year and a half ago. I had a long career in the IT industry, doing architecture and systems analysis. So sort of it's been bred into me to do a lot of in-depth analysis and stuff. So the reason I say that is because in my investing, like I do everything else, I actually deep dive in things, and I don't do things half. I have to actually know everything inside out just because of my old career. So I've also am an entrepreneur. I run my own side business. I've actually been a mentor for small, young youth startup communities for several years. I've done that. I've been interested in investing since I was a teenager. Actually, I did crazy things even as a teenager, bought the first penny stocks and stuff. And yeah, didn't do good, of course, but I was interested in it then. And I've come and gone from the investment community. I'll say as a loner, I've never been in a community like we have now with Blossom and stuff like that. But I've always been interested in finance and markets and stuff like that. Until a few years ago, I'm like every other, I guess, investor that in the sense of saving for my retirement. I was a long lifer using Altamira and the Royal Bank on, bank managed balanced portfolios. You just every month, here's my money, put more money into my balanced portfolio, and basically it slowly but surely went up and up and up. And, sometimes it went down big time. So I sometime about 5-6 years ago, I never liked when the downs happened on my balanced portfolios, because it's like you figured it took 2 years, 3 years to go up 10 or 15%. And then in 1 year, like 2008, it all goes away. And it sort of got frustrating. It's like, am I ever going to get enough money to retire? So about 5 years ago, I started getting the itch of saying, there's got to be a better way. Like maybe I could do it better. These MERs were high, and it's like, the income coming from it, I saw almost none of it. And the growth was like, in my opinion, 5-6% is like, okay, can I actually live off that? So I started getting interested in saying, maybe I'm going to do my own thing. And I'll say in late 2022, I took a dive and I said, okay, what I'm going to do is I'm going to take one of my accounts, my joint non-registered account, and I'm going to start playing. I'm going to start opening up a direct investing account and start coming up with ideas how I can try to do better in finding a way to retire. And I'll tell you, those first few months were all over the place. So I tried things like, like I said, Suncor and Enbridge. My objective always is I wanted to have more income. Like growth was not my interest anymore, because I was like, to me, especially as a retiree, and a lot of retirees or those planning to retire the same way, it's like, I can't live off growth. I got to live off income. I got to have that same paycheck every month that I had when I was an employee. And the only way you do it with growth is to start eroding your equity, or as they refer to it in the industry, melting it down. And I was like, well, there's got to be a better way than melting it down. Why can't my portfolio, as big as it is after all these decades, do more than melt down? Why can't it generate enough income so we can actually stay stable? Maybe even go up, but even stay stable or erode slower. So I started looking around. The dividend things were really all over the map. Like, yeah, I got some dividends, but they were small. And then, of course, Suncor goes down about $10 in your so, and then basically, it's the weirdest thing. It was January of 2023. I was still employed, and I was working on the side right where I'm sitting right now, or the side. I always had my BNN news network, business news network from Canada up there. And I started seeing these advertisements for HMAX from Hamilton. And it was like, what? 15%? How can an ETF give me 15%? And it sort of triggered my mind, like, okay, I got to investigate further on this. So honestly, when people ask, how did I get into passive investing? It was those commercials on BNN that were showing HMAX, which then started me Googling, looking at it. And of course, I ran into people like, all of a sudden, you know how you do Google when you talk about passive income and you talk about HMAX. now people like Adriano started showing up on my YouTube feeds, and I started watching him. And I actually interviewed the Hamilton ETF managers, because I heard a lot of things about erosion and stuff like that. So it's interesting to hear people talk about it, but I won't believe anybody unless I hear it from the horse's mouth. And I like doing critical thinking and research because there's a lot of people that just say things and repeat it like a parrot to say, oh yeah, it's erosion. It's erosion. It's like, okay, let's see if it really is erosion. So I asked people about rock and stuff like that, and the actual people from Hamilton that were running the fund, and they explained it in detail. Very good that they did that for me. And I started believing in it. Like, I really started seeing that, you know what, these covered call ETFs have some merit. Like, why, if the hedge fund managers in the 70s were doing it for their wealthy clients, why can't the average retail investor do the same thing? So I really started researching. I bought my first covered call ETF, which was HMAX. I think it was in March of 2023. And it started from there. And my portfolio, you can see, is grow. I did one account with my non-reg. Then I started moving my TFSAs in there, and then I moved into my RIFs, and it moved on all the way. So by the end of 2023, I was sold. Like, I understood exactly what I wanted to do. Being an IT architect, I was very used to the idea of making sure that you had to have fail safes and diversification, because to me, diversification is a pillar of my portfolio, to say, at any given time, I don't want one of my ETFs taking down my entire portfolio. So if you ever look at my portfolio, I've got 26 ETFs spread over 7 accounts. And I do that not because I like managing all these ETFs. I do it because that way, if one goes down, I'm only down by 5%.
You're trying to spread the risks, right?
Yeah. And so by the end of 2023, that's exactly when I retired. When I retired, my wife and I had to make a huge decision, because I took all my managed portfolio money and moved it into covered call ETFs and started expanding I call it my catalog of ETFs into all my accounts. But the one that was coming up on retirement was, my company had a pension plan. And I had to make a big decision. Do I run on this company pension plan, or do I commute it? If I really believe in this portfolio strategy, should I commute it? Should I cash it out and put it into my portfolio? The decision for me wasn't that hard, because my company pension plan was non-indexed. As it was non-indexed, I was like, okay, the same $2,000 I make now, I'll make 30 years from now, which is only going to be equal to about $600. So I said, and it disappears when we die, so there's nothing to give my kids. So we made the decision. It was scary, but we made the decision to commute my entire pension. And so the reason I'm at around, when I finished in 2023, I was around 1.2 million in there. I'm currently at 1.4 million in NAV, and that's where I am right now, and just maturing and expanding and fine tuning and rebalancing. And sorry, long question.
That's a good one, Perry. And I know you did talk about the various accounts that you have, and I think you've also talked on that on Blossom. You are actually also actively using a portion of the cash flow that comes in through these accounts. So it's not like because you're retiree, naturally you're using it. Can you touch on that as well? What portion of those you're using? And maybe at some point, once we get to that, you can maybe share some of your screens. I know you do a very diligent tracking as well. We've read some of the posts. Now there's a lot of interest on that.
So again, there's people that haven't retired yet, and they're like, what am I going to do with my RRSPs and my TFSAs, and what do I do with my non-reg? With me, of course, there's 3 categories. There's my non-reg. There's my TFSAs, which my wife and I both have a TFSA. And then we have our RRSPs, which we've already converted immediately to RIFs. Some people's like, oh, what, you shouldn't, don't wait till you're 60, 65, whatever. No, there was no benefit for us to actually wait. We converted all our RIFs in our first year from all our RSPs to our RIFs. As soon as my portfolio had been converted over, for January 2024, all our RSPs were converted to RIFs, because I wasn't planning on putting more, because only if you're employed can you add more, and I had no need to add more. So And there's benefits of the RIF that like for example, successor is something you can now add with a RIF that you can't do with an RSP, which is good if you're passing away. A successor mode basically means your wife gets all of it non-liquidated. It just gets it, right? So there was big value. So we converted my RIFs. I have 4 RIFs. And the only reason I have 4 RIFs is because I had a LIF, or I had a LIRA. And a LIRA basically cannot be a RIF. So my RSP turned to a RIF. My LIRA had to turn to a LIF, right? Which is its version of a RIF. Yeah. And there's a special mode in taxes and for superannuation for LIFs that you could do a one-time withdrawal of 50% of the LIF and move it out of it so that it doesn't get restricted, because LIFs are restricted. So I pulled half of the LIF out and created a new one called a PRIF, which in all intents and purposes is the same as a RIF. So I have 3, and then my wife has a spousal RIF. So that makes our 4 RIFs. And then we have our 2 TFSAs. So that's where we do it. That being said, my portfolio, if you look at my 26 ETFs, for the most part, all my ETFs, all 26 are basically, I won't say 100%, but they're almost all 26 are in all of the RIFs in all of the TFSAs.
They're spread out across,
yeah. So when I say I have 26 ETFs, I actually have 26 times 6.
Yeah.
So I have over 100 ETFs actually. So some of them aren't fully loaded, like my LIF and my PRIF basically have all the ETFs. My RIF and my wife's RIF does not. There's a few that I haven't done in those. So they're like maybe at 20 or 21. And my TFSAs are actually even more restricted, because my focus for my TFSAs is to generate as much income as possible. So they focus a lot more on our higher ultra yielding covered call ETFs, the American ones, HHIS, and all the harvest ones, which I'm very excited about. They've gotten to them. And I've eliminated a lot of lower CC covered call ETFs, like the ones generating under 20% for the most part, or under 18%. I don't use in my TFSAs because I want to actually.
What criteria do you use, Perry, when it comes to deciding on those covered calls? Given that it seems like the majority of your portfolio is in covered calls, you do have, of course, a few growth-oriented stocks. But what are the criteria you use to selecting which ones to invest in, which ones to trim?
Okay, yeah. So I should say I also have 15% of my entire portfolio is non-covered call ETFs. They are pure growth stocks. I only hold them in my non-registered account. I do not hold any ETFs or anything in my non-registered, not because it's a bad idea. It's only because I'm lazy and I don't want to deal with the ACB. So I basically said, just keep my growth stocks in my non-reg. When it comes to deciding, I actually have, when I started my portfolio, I wrote down my own rules. What would I invest in? What would I not invest in? And I know it sounds corny. Says, well, why would you write that? But it really does help when you actually write down the rules of what is it that's going to make you disciplined, so you don't go off on a straight, oh, I'm going to buy some Apple stock. Well, no, your rules were that you said you wanted income. Well, Apple doesn't generate income, so why are you doing it? Another one I say I have about 15 rules that I've written. I've actually written them down. I've actually posted them in Blossom. But for example, I won't invest in closed-end ETFs. I won't invest in split ETFs. I had a rule, but I've removed it, that said I won't invest in any single stock ETFs. Well, I sort of violated that by doing harvest ETFs and the yield maxes. So I had to take that rule out because I just use it too many times. So and basically my rules on diversification. So that when you ask what do I decide to buy, I make sure that my ETFs that are going into my portfolio is well diversified. I don't want them all to be on the NASDAQ. I don't want them all to be American. I want Canadian. I want some banking. I want some finance. I want some energy. I want some high risk. I want some low risk. So they're more general. The decisions are more general. And what I've done is basically on my spreadsheet, I actually have what's called target holding weight. So I basically, for every ETF, saying, okay, I want to make sure that I have some NASDAQ index ETFs. So I look at it and say, okay, I'm going to maybe do about 10%. And since my rule is I don't try to have any more than 5% in any one holding, that's one of my other rules. I basically look at, okay, so which ETFs can give me that NASDAQ up to that 10%? And I don't go over that number. If I do and it's getting too high, my target state will say, my spreadsheet will say you're a little bit over on your target state. You might want to either rebalance and sell some of them and move them somewhere else. So my decisions are also based, my spreadsheet tells me everything. Like, it's the one that I always look at and I say, okay, yeah, I'm a little bit high on CONY. Like I should only have 4% and I'm at a rate 6%. Then I decide, should I trim some of that off and move it? That happens. Some tough decision you have to make, because it's funny because a lot of the growth investors say, oh, covered call ETFs, they never grow. Well, I've got several covered call ETFs that I've actually had to sell because they've gained so much in NAV that my holding weight was getting too high.
Yeah, interesting.
And a lot of them were the Canadian ones, like call. I've had to sell about 40% of my call ETF because I've generated so much capital gain on it that I actually reduced it, trimmed it down, and put it into some of the others. So that's how I make my decisions. It's basically it's a several factors, but a lot of them is, how do I maintain my diversity? How do I stay within my target weights? I do rebalance my targets as well. Like my targets don't stay targets. Sometimes I'm like, oh, I've introduced a lot of HHIS and some of these new ETFs. Well, I got to add them in there. So then I have to rebalance all my targets because this is a new ETF that the portfolio never knew about. So I have to actually
you adjust it accordingly as based on that.
My portfolio is currently at 1.47. Of course, that's going up and down any day because it's tracking it minute by minute. It's basically saying that I'm at a profit of 450 something thousand, because it basically takes my losses, my capital losses versus my dividends and income earned. I'm currently having an IRR, or a rate of return, basically of 19.5%. But if you look at the number below, it says minus 15. That basically says that my NAV is minus 15.
Right.
So basically my portfolio in a book cost is about 1.7, but my current value is 1.45.
Right.
So it's basically at minus 15. But when you add all the income I've generated, I'm currently running at an IRR of 19.5%. And again, because I'm a passive income investor, not a growth investor, I don't lose sleep at night because my portfolio is down 15%, because it's all unrealized. And one of the strategies for passive income is buy and hold. And since I'm buying and holding, that loss won't be realized unless I actually sell it. And even when the NAV on things like CONY is down, in that one, mine's down about 60%, it's still producing monthly income. It's just that the NAV is down on that CONY. So I don't really lose sleep at night that I'm down 15%. And then the other one is basically, this one number here is telling me what is my projected yield over the next 12 months. Currently, my projected yield is 37.5% about that. So they sort of figured that I'll be making about $540,000 in the next 12 months. So this is dividends received. And you can see all time. If you notice that even though my NAV has gone down versus my book cost, the one thing you've noticed is, so I started here. This is March of 2023 when I started. Yeah. And you can see constantly it's been going up, and it's been hovering now in the 40K per month range. So I generally make about 40K per month. During the Trump tariff days here, you can see these two are really low. That's when he was announcing all the tariffs and stuff. And basically not only did the markets go down, but also respectively, the income generated went down as well. So you can see I had 2 months there where it was low. And then the next month it's skyrocketed back up. But on average, it's projecting that I'm going to be making around 45,000 over the next 12 months is what I do. And I reinvest a lot of people have asked me, how much do I have to reinvest? Do you have to reinvest, or will the passive income basically go to zero if you don't do it? I more look at it, how much money do I need of that 45K per month? A good thing when I was with RBC, they did a full retirement plan, and they said, how much money do you need? So they did a good deep dive analysis. And my wife and I generally need only to live about $5,000 or $7,000 a month. to pay our bills and, you know, gas and insurance and stuff like that. So to me, if I maybe pull out about 10,000, because let's say I'm going to do a living room project like I'm doing right now, or I'm going to buy a hot tub, they say, okay, well, I need more than that for this one because I'm going to buy a hot tub that's 20,000, so I'll take that and that. But if it's not, and it's just an average month, and I only need about, say, 10K, I basically take the 10K out, and my RIFs do it automatically because they have to. They pay, but they take out minimal amount. They only take about 8,000 out. And then often that's enough. All I need. It's just what the RIFs are paying out. And that's only a small part of what they earn. So what I do after that is if I've paid out everything I've had to pay out for the month, the rest I reinvest. I don't do it because I have to. I do it because I want to do it so that I can keep growing. The more money I can make over the next few months, like if I can get into the 50K per month and 60K per month, it gives me even more window of safety. So yeah, we have a really bad markets crash and it goes down 50%. Well, 50% of 50,000 is still 25,000, and I'm still way more than I have to live on. So to me, I always want to try to keep growing the portfolio so that it can generate more income, not so that it can maintain its NAV, but so it can generate more income. This tab here shows all my ETFs, what their name is, what their current price is, what is the target holding weight for them, what was their last dividend that they produced. It basically goes into a 6-month average of dividends that are, or distributions that were paid, so that I know what the average distribution over a 6-month period is for every ETF. I know a 6-month period of what the stock price was. And this basically is my ETF page. The executive summary is just for me for financing. So it says, show my entire family cash flow. It adds my taxes and everything. This is all my charts that sort of takes the data and turns them into graphs. So if I want to know what is my yield, for example, on all my accounts, this shows me my yield on all my accounts. So they're running from 32% up to 38% on my yields and stuff, but it shows me all my holdings, all the stuff like that. This is the one that I live off of every day, is this tab. This tab is the consolidation of every one of my other accounts coming together and being put into this spreadsheet here. And this one shows me everything. Book costs, current prices. It shows me what my latest income is. It shows me what my yield on cost and yield on cost averages. So, or not yield on cost, yield 6-month average and current yield. So that I know what is my yield on last payment, but what's my yield on my last 6 months. That's very important because it shows me trending. It shows me, so if you could see right here, it will show me how much money each one of my ETFs make. And again, it's detailed, so you don't have to really focus on it. But it says, hey, you noticed your one ETF is actually below your 6-month average for the last couple of months. So I can see if somebody's starting to underperform, and it gives me some red flags that I can say, hey, you know, I'm really not liking this. For example, haven't been happy with Roundhill for a couple of months. And it sort of gives me the heads up of maybe I should start thinking of doing something, or maybe I'm not. But the spreadsheet gives me that data so I can do it. Then it tells me a whole bunch of stuff here on my yield. It tells me this one here shows me how many years before it's fully paid off. The nice thing with covered call ETFs, especially the ultra high ones, in about 1, 2, or 3 years, all that you invested in it will actually be paid back to you in basically distributions. So this one is telling me for each ETF, how many years will it take for me to get all the money that I paid into it back. So
to essentially recoup your initial investment type of thing.
Yeah, and some people like retire on dividends, which is a guy I've followed along in YouTube forever. It's called house money. So when do I get to house money? Where basically, even if it fell off the face of the earth, I got all my money back. So that's what that one is. And then this one here is the one when you ask the question of how much, what do I decide which ones to buy? These over here show me where is my ETF's holding weight compared to my target. So when you see something in yellow, it's showing me that I'm over my target. That means if I had to sell something, this is something I should sell. If it's in blue, it means I'm underweighted. It means if you have another $10,000, Perry, you could put it into any one of the blue ones because they're underweighted. So HHIS is still a little bit underweighted. So next month I might say, oh, it says I could buy 950 more units. So maybe that's where I'll reinvest some of my money because I can bring that one closer to zero. So that's where that happens. And then the last thing in down over here basically shows all the income that my RBC direct investment account actually collected. So this is the money that actually comes into my account every month.
Mm-hmm.
And I hand bomb it. A lot of people actually have their brokerage account linked to these sources. I don't. I literally go through my RBC. When it's payday, I actually go there and I write them down, and I'm actually right down to the penny. I
You
write
stay
them
on top
down.
of it
And
very closely.
yeah, and I do that not only I mean, it sounds like it's a pain in the rear end, but I do it because I want to really know
Mm-hmm.
which account is bringing which money. And by actually doing it manually, it actually forces me to actually stay in touch with my spreadsheet, with my Snowball Analytics, with my Yahoo Finance and all
Mm-hmm.
that. So it's a little bit of a regimented procedure every week, because every Friday I get paid because of the weeklies
The weekly
that
ones,
happen.
yeah.
So yeah, I go through this, and it basically all conglomerates up to here. Out of my portfolio, which is my favorite of
Yeah.
all my holdings, my most favorite is Athabasca,
Yeah. The
which
stock,
isn't
right? Yeah.
even a covered call ETF. It's
Yeah.
actually my oil stock, my Canadian oil stock. It's been my darling. It's generated so much capital gains on me that has actually helped my ETFs grow, because I basically capitalize my gains from Athabasca. And then when next January shows up and the TFSAs have more headroom, all that money gets pushed in there from Athabasca. So Athabasca is my number one darling,
Mm-hmm.
if you have to ask which one.
Mm-hmm.
But out of my ETFs, the latest one I've actually really been liking has been PLTY, the Palantir one from YieldMax, and the harvest version of it as well, PLTE.
Mm-hmm.
PLTE, I'm not only gaining great income from it, but again, going in the argument, oh yeah, they covered call ETFs never grow. Well, I'm up about 45% on my on my PLTE in capital gains, unrealized, as well as it's gaining some huge numbers on income. A lot of people ask me which ETFs should I buy, and it's like, well, it's not my choice. I'm not an advisor. I'm just an average retail investor. But if you want safety, the Canadian ETFs are by far the more safer covered call ETFs. They run in a yield between 12 and, well, now with the harvest up to 50%. But they tend to be a lot more stable in NAV, stable in income. Matter of fact, a lot of my Canadian ETFs, they are so boring to do distributions because it's the exact same number every month. I literally copy paste, because the ones from Evolve and Harvest tend to not change at all, which if you want stable income, they're good. They don't generate the 50, 60, 70% yields, but they generate a very stable, constant. The NAV doesn't go up. It's always in a price box, because some people, oh yeah, no, the covered call ETFs, they erode. Well, no, they don't. They decline and rise, just like a stock like Tesla climbs and rises, but they generally stay within a trading box. So, HDIV has been down to about 13 and it's been up to about 18. So I don't worry if HDIV is down to 1290 or if it's up to 1890. As long as it stays in that price box and
You're
keeps
happy with it?
providing me income,
Yeah.
I'm happy. So
Yeah.
I
This
would
is
say that
great.
would be one of my favorites, but it's hard to say because each one has its own reason why it's in
Uniqueness.
my portfolio,
Yeah.
right? So,
Yeah.
yeah, like if people ever turn around and say, if you do another interview with them, ask them these questions, I would be,
That'll be good. Awesome. Well,
yeah,
thank you so much, Perry. I really appreciate your time today,
okay.
and I'll look forward to chatting with you again soon.
All right. Thank you very much.